Hello and welcome to the CPA Australia podcast, your weekly source for accounting, education, career and leadership discussion.
Hello and thanks for joining us today. My name is Eleanor Cassipedes and I am the Senior Manager of Tax Policy at CPA Australia. Today on the CPA Australia podcast, we will be discussing Tax Time 2021 with Assistant Commissioner Tim Lowe from the Australian Taxation Office. In this episode, we will focus on cryptocurrency to help you with your client conversations and be aware of the ATO's focus areas this tax time. Our guest today is from the ATO's Individuals and Intermediaries Division. It's a pleasure to welcome you, Tim.
Hi, Elle. How are you going?
Good. So, second podcast out of 4. We covered work-related expenses in our first podcast. This time it's all about cryptocurrency, the new frontier of investing. Now, the ATO has been on the case for quite a few years, but this tax time you've really been on the front foot about cryptocurrency. What is it and why is it an issue for the ATO?
Look, thanks, Elle. Look, the term cryptocurrency is generally used to describe a digital asset in which encryption techniques are used to regulate the generation of additional units and verify transactions on a blockchain. And you're right, the growth in popularity of cryptocurrency across the community means the ATO will also be increasing our focus this year on cryptocurrency. Look, the prices of cryptocurrency have skyrocketed over the last 12 to 18 months. In April this year, Bitcoin, for example, was trading at $80,000. It's come down a little bit from that high, but given the rise in prices, a lot of people are attracted to investing in cryptocurrencies now. And this increase in investment in cryptocurrencies, we just want to remind people this tax time that they must report a disposal of cryptocurrency for capital gains tax purposes in certain circumstances.
And you sort of mentioned a lot of terms like blockchain and crypto, and for many people it really is just about getting into an opportunity that seems to be growing. And you mentioned capital gains tax. So it's really about getting out there and reminding people that even though it might be something new, it's not that there isn't a tax consequence or that the laws haven't kept up with the pace of change. Is that correct?
Yeah, that's right. So, look, while cryptocurrency may appear to operate in a digital world, when it interacts with the real world, the ATO keeps a close eye on what's happening in the cryptocurrency world. So we'll get information and data from banks and financial institutions and cryptocurrency exchanges, and we'll track that money and the information back to taxpayers. So what I would say is this: think of cryptocurrency like shares. So similar tax obligations arise from trading in cryptocurrency or investing in cryptocurrency. So typically there's 4 transactions that can trigger a capital gains tax consequence if you're an investor. So if you sell or gift cryptocurrency, if you exchange cryptocurrency for another cryptocurrency, so if you swap Bitcoin for Ether as an example, if you convert cryptocurrency to a fiat currency like Australian dollars, or if you buy goods and services with cryptocurrency. So those are typically the 4 transactions that can trigger a capital gains tax consequence.
And a lot of people, when they get into this, they're not necessarily thinking, oh, this is what I'm going to do with it, or this is the information that I need to keep. They sometimes don't even think about how they're purchasing it, like in their own name or through a company or even through a self-managed superannuation fund. Is that 50% discount available for individuals who hold crypto for more than 12 months?
Yeah, that's right. That's a good question. So if you're holding cryptocurrency in your own name as an individual, and you have held the cryptocurrency for more than 12 months, or at least 12 months, you can get a capital gains tax discount. So it's something to think about if you're an investor, just to remind yourself that if you held it for at least 12 months, you can claim a capital gains tax discount.
And you did mention those record prices of $80,000, and you also mentioned that things have piped down a little bit since then. If I make a capital loss, so if I sort of bought high and sold low because I just wanted to get out, it got a bit too risky for me, can I also have capital losses available for me?
Yeah, good question. Oh, yeah, yes, you can. So, let's say, for example, you bought in April this year and you disposed of it recently, say maybe yesterday, for example, and I think it was trading at about $48,000, so you would have made a $32,000 capital loss. Um, Look, that would be bad luck, obviously, but yeah, you can use that capital loss and offset it against other capital gains that you've made during the year. So if you've made some gains in relation to shares or property, you can offset that capital loss against those capital gains.
And I liked your share analogy before, because a lot of the time the terminology is what seems quite foreign, but boiling it down to the basics. The other thing that I've heard around the traps is chain splits and forks. So it like a particular currency might actually end up splitting into two different forms, or there's a different kind of, it goes onto a different blockchain. Um, do you have any advice? So if a client walks into a tax agent's office and says, well, I started off with some Bitcoin, but then it forked and I got these new things, what do I do? Do you have any guidance or information on that?
Yeah, you can run to our website. I think that's a good start, and don't freak out. It's probably the second piece of advice. But look, I think from a tax perspective, chain split implications where cryptocurrency is held by an investor as an investment, are such that if you hold cryptocurrency as an investment and receive a new cryptocurrency as a result of a chain split, such as Bitcoin Cash being received by Bitcoin holders, you don't derive ordinary income or make a capital gain at that time as a result of receiving that new cryptocurrency, but instead you'll make a capital gain when you dispose of it. So when working out your capital gain, the cost base of the new cryptocurrency received as a result of the chain split is zero. And also, if you hold if you hold the new cryptocurrency as an investment for at least 12 months, you may be entitled to the CGT discount as well. So yeah, that's something that people need to think about, in the context of chain splits. And another thing to note is, in respect of chain split implications, where cryptocurrency is held in a business that's been carried on, a new cryptocurrency received as a result of a chain split in relation to cryptocurrency held in a business carried on will be treated as trading stock, where it's held for exchange or sale in the ordinary course of the business. The new cryptocurrency must be brought to account at the end of the income year, given that it's considered to be trading stock.
So it's gone from something quite unfamiliar to a language that I think many tax agents are very, very familiar with. So really it's just another asset and you just treat it the same way.
Exactly.
Yeah. So you did mention, though, that being in business, you're treating it as trading stock. So there is that line between, and the vast majority of people are going to be investors. But let's say I'm buying and selling relatively small amounts of cryptocurrency, but I'm doing it pretty regularly. I'm no millionaire or anything because I didn't buy Bitcoin early enough or sell it at 80,000. But I spend a lot of time monitoring exchanges. I read those Reddit threads and, I'm doing courses. I think I'm not quite sure whether I'm in business. Am I a trader or am I still an investor? And the reason that it matters to me is that 50% discount for the currencies that I do hold for more than 12 months, even though I'm sort of maybe trading some others on a more regular basis. What are sort of the factors do you think that the ATO will look at in that kind of scenario?
Yeah, it's a good question, Elle. Like, I think for most people, as you quite rightly pointed out, for most people, they're going to be investors in cryptocurrency rather than traders in cryptocurrency. From our perspective, we'll obviously look at a number of different things in terms of how long you um, hold the cryptocurrency for, how often you're trading cryptocurrency. So from our perspective, it's really going to depend on the facts and circumstances of each particular person. But as I said before, for the most part, most people will be investors in cryptocurrency, and so they'll be entitled to a capital gains discount if they've held it for more than 12 months, and if they've made a loss, they'll get a capital gains tax loss, which they can offset against other capital gains that they've made during the year.
That's really helpful. And when we're talking about business versus investor, and then people look down and they go, oh, but personal use asset. There have been people, though, who have, right from the beginning, they want to use Bitcoin as a form of currency to buy and sell things, or they will buy crypto on a particular site or for a particular set of purposes. How does the ATO look at those kinds of purchases and sales of crypto?
Look, broadly, cryptocurrency won't be a personal use asset if it's kept or used mainly as either an investment, part of a profit-making scheme, or in the course of carrying on a business. But, cryptocurrency can be considered to be a personal use asset. So if you acquire and use it within a short period of time, or directly exchange it for items you personally use or consume, it's likely to be, a personal use asset in those particular circumstances. But look, the longer you hold cryptocurrency, the less likely we consider it to be a personal use asset. So, if you held it, say you bought it last year and it was only like, say, $30,000, and then you sold it and you held on it for about 5 or 6 months and sold it at $80,000. Well, I don't think that would be a personal use asset in that particular circumstance. But if you bought it and then, let's say, next week you used it to buy something, then I think that would be more of a personal use asset. Yeah. But yeah, again, it's going to really depend on people's facts and circumstances. We've got some information on our website that agents can check out to have that discussion with their clients about.
Yep, awesome. And finally, just on crypto, I noticed that the ATO just refreshed its data matching protocols up to 2022-23. Where are you getting the information from, and what will you be doing with it?
Yeah, look, we get information from a number of cryptocurrency exchanges. So, as you quite rightly pointed out, Elle, we've got a cryptocurrency data matching program that has been in place since April 2019, in which we, as you quite rightly pointed out, we've just recently extended for a further 3 financial years, up to and including the 2022-23 financial year. As I said before, it might seem that cryptocurrency transactions operate in an anonymous digital world. But as I said before, we get a lot of information and records from cryptocurrency designated service providers as part of this data matching program. And we use that to match this data to an individual to ensure people trading in cryptocurrencies, are paying the right amount of tax. And that data that's provided to the ATO includes cryptocurrency purchase and sale information. So we use that information to send letters to taxpayers as one example. So this year we'll be sending 100,000 letters to taxpayers to remind them of their cryptocurrency tax obligations. And we'll also be nudging people or sending pop-up messages to 550,000 Aussies who've been trading in cryptocurrency this year to make sure that they include any of their gains or losses in their tax return. So tax agents will be able to get that pop-up message as well when they're helping their clients put together their tax return. Now, in addition, where clients don't report their transactions in their tax return, something to note is that returns may be delayed while we review why amounts related to the cryptocurrency have not been included. And we can subsequently contact the client to review their affairs or any missing transactions. And in cases where we believe clients have been deliberately avoiding their cryptocurrency tax obligations, we'll be increasing our compliance activities through audits and, where necessary, the application of penalties. So we want to help tax agents and taxpayers to get it right and ensure they're paying the right amount of tax. And as I said before, we'll be using that data to remind people to include those cryptocurrency transactions in their tax return this year.
Those are some big numbers. I know that 1 in 5 Australians is investing in crypto, but for you to be actually matching that and sending out those hundreds of thousands of notifications, what's really useful is having those as pop-up messages. So that's fantastic. What I heard from this podcast was declare cryptocurrency gains and losses. Don't think that it's not a problem or that the ATO won't find out. And the other part of it is just making sure that it's treated correctly and that it's not necessarily this new whiz-bang kind of asset. It is very much treated like existing assets such as shares. Thank you so much for your insights today, Tim.
Thanks so much for having me, Ellen.
In our next Tax Time podcast with Tim, we'll be covering property investment. Be sure to visit our show notes on the CPA Australia podcast webpage for links and more information on this episode. Thanks for listening.
Thanks for listening to the CPA Australia podcast. For more information on today's episode, please visit the show notes at www.cpaaustralia.com.au/podcast. Never miss an episode by subscribing to our podcast on Apple Podcasts, Spotify or Stitcher.